Let me ask you something. When you hear someone talking about buying gold, what's the first image that pops into your head? Be honest. Is it some guy in a bunker with canned beans and a tinfoil hat, waiting for society to collapse? Yeah, I thought so. And you know what? That's exactly what they want you to think. Because while you've been dismissing gold as something only paranoid conspiracy theorists care about, some of the smartest money in the world has been quietly accumulating it at a pace we haven't seen in over 50 years. And I'm not talking about your uncle who watches too much cable news. I'm talking about central banks, sovereign wealth funds, the people who literally control the financial system. So here's what we're going to do today. I'm going to show you the actual data, not opinions, not predictions, just cold, hard numbers that tell a story most people are completely missing. And by the end of this, you're going to understand why dismissing gold as a doomsday prepper asset might be one of the most expensive mistakes you could make right now. Let's start with something that happened just 3 weeks ago that barely made the news. Poland's central bank announced they added another 25 tons of gold to their reserves in the third quarter. Now, you might be thinking, okay, so what? Poland bought some gold. But here's what makes this interesting. Poland now holds 445 tons of gold. That's more than double what they held just 5 years ago. They've gone from gold representing about 5% of their reserves to over 16%. And Poland isn't alone. Turkey added 39 tons in the same quarter. China, which is notoriously secretive about their gold purchases, added 23 tons that they actually reported. Most analysts believe the real number is significantly higher because China has a history of buying gold through back channels and only reporting it years later. India added 9 tons. The Czech Republic added 4 tons. You see where I'm going with this? These aren't doomsday preppers. These are the people who run countries. The people who have access to every economic indicator, every piece of intelligence, every data point you could possibly imagine. And they're buying gold like it's going out of style. But let me show you something even more revealing. In the first 3 quarters of 2024, central banks purchased over 800 tons of gold. That's on track to be the 3rd consecutive year of purchases exceeding 1,000 tons. To put that in perspective, before 2022, the last time central banks bought more than 1,000 tons in a single year was 1967. Let that sink in. We're seeing buying behavior that hasn't occurred in nearly 60 years. Now, why does this matter? Because central banks don't do anything quickly. They don't panic buy. They don't make emotional decisions. When you see this kind of coordinated, sustained buying across multiple countries, across different political systems, across different economic situations, it tells you something fundamental is shifting in the global financial system. Let me tell you a story that perfectly illustrates what's really happening here. In 2008, during the financial crisis, I remember talking to a portfolio manager at a major pension fund. This guy managed billions of dollars, and he told me something that stuck with me. He said, "We don't own gold because we think the world is ending. We own gold because we know the world is changing." At the time, gold was around $800 an ounce. His fund had about 3% of their portfolio in gold, which was considered aggressive back then. Most institutional investors had 0. Gold was still seen as this fringe asset that serious investors didn't touch. Fast forward to today, and that same fund has 12% in gold. And they're not alone. Here's what changed. In 2008, we learned that the financial system we thought was rock solid could nearly collapse in a matter of weeks. We learned that banks we thought were too big to fail could actually fail. We learned that the government's response to crisis was to print unprecedented amounts of money. And we learned that this money printing didn't just happen once and stop. It became the standard playbook. Since 2008, the Federal Reserve's balance sheet has gone from under $1 trillion to over $8 trillion at its peak. The European Central Bank went from basically nothing to over 8 trillion euros. The Bank of Japan's balance sheet is now larger than Japan's entire GDP. Think about that. The central bank owns more assets than the entire economic output of the country. And here's the thing nobody wants to talk about. This money didn't disappear. It's still out there. Sure, the Fed has tried to reduce their balance sheet a bit, but we're still sitting at levels that would have been considered absolutely insane just 20 years ago. And every time there's even a hint of economic trouble, what happens? More money printing, more stimulus, more quantitative easing. So when you see central banks buying gold at record levels, they're not preparing for doomsday. They're preparing for the inevitable consequences of the monetary experiment we've been running for the past 15 years. They're diversifying away from a system where the primary response to every problem is to create more currency. But let's talk about something even more interesting: the type of gold buying we're seeing. Because it's not just that central banks are buying gold, it's how they're buying it and where they're storing it. Remember when Germany made headlines a few years back by repatriating their gold from New York and Paris? They brought home over 600 tons. At the time, a lot of people thought it was just political theater, but then other countries started doing the same thing. Austria brought their gold home. Netherlands repatriated a significant portion. Turkey moved their gold from the US back to Ankara. Why does this matter? Because for decades, the standard practice was to store your gold in New York or London. It was convenient. It was liquid. You could trade it easily. But now, countries are saying, actually, we want physical possession of our gold within our own borders. That's not a doomsday prepper mentality. That's a fundamental shift in trust in the global financial system. And it's not just governments. Let me tell you about what's happening in the private sector, because this is where it gets really interesting. In 2023, global gold ETF holdings increased by over 200 tons. But here's the kicker. While Western ETFs saw outflows, Asian ETFs saw massive inflows. Chinese gold ETFs added over 60 tons. Indian gold ETFs grew by 40 tons. What does this tell us? It tells us that while Western investors have been distracted by tech stocks and crypto and whatever the latest hot investment trend is, Asian investors, who historically have a much deeper cultural connection to gold, have been accumulating. And these aren't just retail investors. These are sophisticated family offices, institutional investors, and high net worth individuals who understand what's happening in the global economy. Now, let me address something important here, because I know what some of you are thinking. Okay, but gold doesn't pay dividends. It doesn't generate cash flow. It just sits there. And you're absolutely right. Gold doesn't do any of those things. But that's actually missing the point entirely. Gold isn't an investment in the traditional sense. It's insurance. It's a store of value. It's a hedge against the debasement of currency. And right now, with global debt at record levels, with central banks still holding massive balance sheets, with geopolitical tensions rising, with the dollar's dominance being questioned for the first time in decades, that insurance is looking pretty valuable. Let me give you a specific example. In 1971, when Nixon closed the gold window and ended the dollar's convertibility to gold, an ounce of gold was worth $35. Today, it's over $2,000. That's not because gold became more valuable. It's because the dollar became less valuable. Gold didn't go up. The dollar went down. Gold just maintained its purchasing power while the currency was debased. Here's another way to think about it. In 1971, the median home price in the United States was about $28,000. At $35 per ounce, that's 800 ounces of gold. Today, the median home price is around $400,000. At $2,000 per ounce, that's 200 ounces of gold. So in dollar terms, houses got more expensive. But in gold terms, houses actually got cheaper. That's what a store of value does. It maintains purchasing power across time. Now, here's where this gets really relevant for you. If you're sitting on retirement accounts, if you have savings, if you're trying to preserve wealth for the future, you need to understand what's happening to the purchasing power of your dollars. Because while the official inflation numbers might say 3 or 4%, your actual lived experience is probably very different. Quick aside here, because this is important. If you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description below. It covers how to get physical gold into your retirement account without tax penalties, how the process actually works, what the fees are, all that stuff. Worth checking out if that's relevant to your situation. No pressure, just information. Anyway, back to what we're talking about. Let's look at what's happening right now in the gold market, because there are some really interesting dynamics at play that most people aren't paying attention to. First, there's a massive disconnect between paper gold and physical gold. On the COMEX, which is where gold futures are traded, there are currently about 300 ounces of paper gold claims for every 1 ounce of physical gold in the vaults. Think about that. If even a small percentage of people who own paper gold decided they wanted physical delivery, the system would break. Now, you might say, well, that's always been the case. It's a fractional reserve system. And you'd be right. But here's what's different now. The amount of physical gold being demanded for delivery has been increasing. In 2023, COMEX saw record delivery requests. The Shanghai Gold Exchange, which deals primarily in physical gold, has been trading at a premium to London and New York. That premium, which is usually just a few dollars, has been as high as $40 per ounce at times. What does this tell us? It tells us that people are increasingly wanting the real thing, not just a paper promise. And when you have a system built on paper promises and people start demanding physical delivery, that's when things get interesting. Let me tell you about something that happened in the silver market that perfectly illustrates this dynamic. In 2021, there was a massive short squeeze attempt in silver. Retail investors, coordinating on social media, tried to buy up physical silver and silver futures to force a squeeze on the banks that were short. And you know what happened? Premiums on physical silver went through the roof. You couldn't find silver coins anywhere. Dealers were sold out. The US Mint had to ration production. But here's the fascinating part. While physical silver was impossible to find and trading at massive premiums, the paper price of silver barely moved. How is that possible? Because the paper market and the physical market had completely disconnected. The paper market, with its massive leverage and derivative positions, was able to suppress the price even while physical demand was overwhelming supply. Now, I'm not saying the same thing is about to happen in gold. The gold market is much larger and more liquid than silver. But the principle is the same. When you have a fractional reserve system and physical demand increases, eventually something has to give. And based on what we're seeing with central bank buying, with Asian demand, with repatriation of gold reserves, that physical demand is increasing. Here's another factor most people aren't considering. Gold mine production has been essentially flat for the past decade. We're producing about 3,500 tons of gold per year from mining. That number hasn't really changed since 2010. Meanwhile, demand has been increasing. So where's the gold coming from to meet this demand? It's coming from existing stockpiles. It's coming from recycling. It's coming from people selling their gold jewelry and coins. But here's the thing about that. Those are finite sources. You can only recycle so much. You can only draw down stockpiles so far. And at some point, if demand continues to exceed new supply, the price has to adjust. Now let's talk about something that doesn't get nearly enough attention. The role of gold in the changing global monetary system. Because what we're witnessing right now is potentially the biggest shift in the international monetary order since Bretton Woods. For the past 80 years, the US dollar has been the world's reserve currency. If you wanted to buy oil, you needed dollars. If you wanted to engage in international trade, you needed dollars. This gave the United States an enormous advantage. We could print money and export our inflation to the rest of the world. We could run massive deficits because there was always demand for dollars. But that system is starting to crack. The BRICS nations, Brazil, Russia, India, China, and South Africa, have been openly discussing alternatives to the dollar for international trade. Saudi Arabia, which has priced oil exclusively in dollars since 1974, has been in talks with China about accepting yuan for oil payments. The European Union has been pushing for more euro-denominated trade. Now, I'm not saying the dollar is going to collapse tomorrow. The dollar is still by far the dominant reserve currency. But the trend is clear. The dollar's share of global reserves has been declining. In 2000, the dollar represented about 71% of global reserves. Today, it's about 59%. That might not sound like a huge drop, but in the world of reserve currencies, that's a massive shift. And here's where gold comes in. Because if you're a country trying to reduce your dependence on the dollar, what do you replace it with? The euro has its own problems. The yuan isn't freely convertible. The yen is tied to a country with massive debt problems. Gold, on the other hand, is nobody's liability. It's not tied to any government's fiscal policy. It's universally recognized and accepted. This is why we're seeing countries like Russia dramatically increase their gold reserves. Russia went from about 400 tons of gold in 2007 to over 2,300 tons today. They've been systematically converting their dollar reserves into gold. China has been doing the same thing, though less transparently. Let me tell you a story that perfectly encapsulates what's happening. In 2018, I was at a conference where a former central banker from an emerging market country was speaking. Someone asked him why his country had been buying so much gold. His answer was fascinating. He said, "When you hold dollars, you're trusting the United States to maintain the value of those dollars. When you hold euros, you're trusting the European Union. When you hold gold, you're not trusting anyone. You're holding value itself." That statement really stuck with me because it gets to the heart of what gold represents. It's not about doomsday. It's not about conspiracy theories. It's about having an asset that maintains value independent of any government's policy decisions. Now, let's talk about what this means for the price of gold going forward. Because if you understand the dynamics we've been discussing, the supply and demand picture, the monetary policy environment, the geopolitical shifts, you can start to see why many analysts believe we're in the early stages of a major bull market in gold. Gold hit an all-time high of over $2,100 in 2024. But here's what's interesting. In inflation-adjusted terms, gold is still below its 1980 high. In 1980, gold hit $850. Adjusted for inflation, that's about $3,000 in today's money. So even at current prices, gold would need to rise another 40% just to match its previous inflation-adjusted high. But let's think about this differently. In 1980, the U.S. national debt was about $900 billion. Today, it's over $34 trillion. That's a 38-fold increase. Gold has gone from $850 to $2,000. That's less than a 3-fold increase. If gold had kept pace with debt growth, it would be over $30,000 per ounce. Now, I'm not predicting gold is going to $30,000. That would require a complete breakdown of the monetary system. But it illustrates an important point. Gold is not expensive by historical standards when you account for the massive increase in money supply and debt. Here's another way to think about it. The total value of all the gold ever mined is about $13 trillion at current prices. That sounds like a lot until you compare it to other asset classes. The total value of global real estate is about $330 trillion. Global stock markets are worth about $110 trillion. Global debt is over $300 trillion. Gold represents less than 2% of total global financial assets. What happens if that percentage increases even slightly? If gold goes from 2% to 3% of global financial assets, that's a 50% increase in price. If it goes to 4%, which is still historically low, that's a doubling of the price. And given everything we've discussed, the central bank buying, the geopolitical tensions, the monetary policy environment, the shift away from the dollar, is it really that hard to imagine gold's share of global assets increasing? Let me give you one more piece of data that I find really compelling. The gold to money supply ratio. This measures the price of gold relative to the money supply. Right now, that ratio is near historic lows. In other words, relative to how much money has been created, gold is cheap. The last time this ratio was this low was in the early 2000s, right before gold went on a 10-year bull run from $250 to $1,900. Now, past performance doesn't guarantee future results. But when you see a pattern like this, when you see gold undervalued relative to money supply at the same time you're seeing record central bank buying, at the same time you're seeing geopolitical tensions rising, at the same time you're seeing the dollar's dominance being questioned, it makes you think. Here's what I want you to understand. The narrative that gold is only for doomsday preppers is not just wrong, it's dangerous. It's dangerous because it causes people to dismiss an asset class that some of the smartest money in the world is accumulating. It's dangerous because it leaves people completely exposed to currency debasement and inflation. It's dangerous because it ignores the fundamental shifts happening in the global monetary system. The central banks buying gold aren't preparing for the end of the world. They're preparing for a world where the dollar is less dominant, where monetary policy is more unpredictable, where geopolitical tensions are higher, where the financial system is more fragile. They're not being paranoid, they're being prudent. And here's the thing. You don't need to believe the world is ending to see the value in owning gold. You just need to understand basic economics. You need to understand that when governments create massive amounts of money, that money becomes less valuable. You need to understand that when debt levels are unsustainable, something eventually has to give. You need to understand that when the global monetary order is shifting, having assets that aren't tied to any particular currency or government is valuable. Think about it this way. If you own a house, you have homeowner's insurance. Not because you think your house is definitely going to burn down, but because if it does, you want to be protected. If you own a car, you have car insurance. Not because you plan to get in an accident, but because accidents happen and you want to be covered. Gold is the same thing. It's insurance for your financial assets. Insurance against inflation. Insurance against currency debasement. Insurance against geopolitical instability. Insurance against financial system fragility. And right now, with everything we've discussed, that insurance is looking pretty valuable. The data is clear. Central banks are buying at record levels. Physical demand is increasing. The paper market is showing signs of stress. The global monetary system is shifting. Debt levels are unsustainable. And gold, relative to money supply and historical norms, is still reasonably priced. So the next time someone tells you gold is only for doomsday preppers, you can show them this data. You can show them what central banks are doing. You can show them what's happening in the physical market. You can show them the monetary policy environment. You can show them the geopolitical shifts. And then you can ask them a simple question. Who's really being paranoid? The people buying gold? Or the people who think the current monetary system can continue indefinitely without consequences? The choice is yours. But at least now you have the data to make an informed decision. Because in the end, this isn't about fear. It's about understanding what's happening in the world and positioning yourself accordingly. And right now, the data says gold is a lot more than just a doomsday prepper asset. It's a strategic holding for anyone who understands where the global financial system is headed.